Assalamualaikum warahmatullahi wabarakatuh. Salam sejahtera, Om Swastiastu, Shalom, Namo Buddhaya, Salam Kebajikan, Selamat Pagi. Good morning and welcome to this international webinar of Best Practice Credit Risk Management, Reducing the Impact on Insurance Industry. Jointly hosted by the Association of Indonesian Qualified Insurance and Reinsurance Brokers, APARI, and the Australian and New Zealand Institute of Insurance and Finance, ANZIIF. I would like to extend a warm welcome to Ms. Katrina Shanks as the CEO of ANZIIF, Mr. Mark Silveira, General Manager Industry Engagement, ANZIIF, Ms. Theo Tran, Regional Director Asia, ANZIIF, and Mr. Bambang Suseno, Chairman of APARI and APARI Executive Board. And to all ANZIIF and APARI members joining this international webinar from wherever you are. ANZIIF and APARI have joined forces again, this time the second time, to bring you this special event, the international webinar for 2024. Now, APARI and ANZIIF itself have been in partnership since 9th of October 2017, when it initially signed the Mutual Recognition Agreement, the MRA, allowing both APARI and ANZIIF members with qualifications to be mutually recognized and obtain the relevant membership qualifications. Now, we encourage all ANZIIF members that have not renewed this year to renew your membership now. Why? Because when you renew today, you will enjoy free membership until the end of this year, 31st of December 2024, and you only have to pay for the next year. So it's like a bonus of 2 months. Ladies and gentlemen, APARI and ANZIIF members, today's webinar brings to the forefront one of the most trending and concerning topics in regards to credit risk and default. As you may recall, during the COVID-19 pandemic, sometimes around 2020 and 2022, Indonesia experienced a credit crunch and defaults when many loans defaults and triggering non-performing loans in Indonesia and other Asian countries, severely impacting the Indonesian insurance industry. Now, what could have been done to prevent insurance becoming the victim of these NPLs and credit defaults? Now, today, our panel of experts will discuss what is credit risk management, typical risk-sharing portion related to bank finance facility, what is the typical collateral used to securitize a typical bank loan financing, be it working capital, trade financing, project financing in Asia Pacific, specifically in Australia. Is credit insurance commonly used in collateralizing bank loan facilities in Asia Pacific? Best practice of structuring collateral and credit risk mitigation, including best practices to avoid future credit defaults and NPLs. What other stuff could have been done to prevent insurance becoming so-called victim of bankers' panic rush? And we will discuss a bit also about the new OJK regulations, POJK number 20, the year 2023, in regards to credit insurance for bank and credit financing. And what does this mean for banks and insurance industry in Indonesia? Now, without further ado, I would like to introduce our first speaker, Mr. Stuart Anderson. I'll be reading a bit of profile for him. Now, Mr. Anderson is the CEO of NCI Brokers Asia Private Company Limited, a specialist credit insurance broker. He has over 20 years of credit insurance experience. He's an international broker who commenced his career in the UK with Trade Indemnity London before moving to RBS, NatWest, the bank's in-house credit insurance broker. He then immigrated to Sydney for a role at Aon Trade Credit before moving to National Credit Insurance Brokers, Australia's largest credit insurance broker. Then he relocated to Hong Kong as manager of Trade Credit and Political Risk Division of Cosmos, part of Japanese conglomerate Itochu. A secondment then saw him move to London to launch the UK operation of Cosmos Credit and Political Risk. Following UK, he then moved to Singapore for over 10 years, running NCI's Asia operations with clients throughout Asia. Recently, he immigrated to Adelaide, Australia to run NCI's Credit Services and Specialty Division. Mr. Anderson has an honors degree from Leeds University Business School in Economics and Social History, and currently is an associate of Australian and New Zealand Institute of Insurance and Finance from ANZIIF. So, Stuart, when you're ready, I think this is time. The floor is yours. Stuart? Hi, Stuart. I think you are still on mute. Just making sure.
Thank you. I've now been allowed to unmute, so I appreciate that. Thank you very much. It's great to be here and I really appreciate the invitation. So I guess from my side, I'm a bit more international, coming from UK and working in many different markets. And the idea today is just to give you a bit of flavor, perhaps for other markets outside of Indonesia, and how that is reviewed from a credit risk management perspective. So I will now share my presentation, if I can manage to do that. So along the lines of the best practices of credit risk management, hopefully you can see this now. Sorry, I'm having a few IT issues at this end. Okay, so what is credit risk management? I think it's important with the experience that Indonesia's experienced recently to understand what the best practices for credit risk management involve. So firstly, it's about identifying the correct customer, the correct debtor, and then analyzing and assessing that same debtor, and then managing and monitoring going forwards, and then clear communication and understanding with that debtor. It's important that we follow good practices, and I'll explain a little bit more why. So hopefully you can read this, and I'll try and speak slowly in case my English is not so clear. But it's very strategic and important for businesses to offer credit to their customers, and it's a critical strategy to allowing a business to grow. It's important to have an updated credit policy and clear documented procedures and relevant forms so all the staff members are clear in the management objectives and how they're going to undertake their credit policy. The documentation, whether that's the credit application form, terms and conditions of trade, any guarantees that you might be able to secure, and the trade is clear and defined. So everybody, both the seller and the buyer, is fully aware of what the terms of payment will be and the basis of what that trade is being undertaken on. It's important that we minimize bad debts.
Stuart, sorry, I had to cut you for a bit. I think your screen hasn't changed, is it? Or you just close and restart then. Thank you. Okay, just restart the presentation.
Can you see that where to start now?
Yep, all good now. Please continue. Thank you.
Great. So it's about minimizing bad debts through an established credit assessment process. And it's important that, as I mentioned earlier, that the whole people in your company that are involved in this is aware of the processes and it's clear. The way that your customers are using credit should be monitored and assessed regularly. And when I say that, it depends obviously on the size of your business and then the debtor's business about when you would assess credit and how often you would assess the credit. But obviously for large exposures where they are owed a lot of money to you or your company, it's important that it's regularly checked. The communication with the customers is very important, and that there is clear, defined discussions with the sales team and with the credit staff. And there should be some healthy discussion between both the sales who want to do sales and the credit team, which is wary of doing open account credit sales because they're worried about the risks associated with that. If you can take guarantees, which I believe in Indonesia, we have clients that do have guarantees. And in other markets like Australia, there's registers for security called the PPSR. And we can then secure the sale and making sure that you have retention of title on those goods and able to have ongoing influence over any insolvency event with your assets that are now sitting with that debtor. So a credit assessment, and I think Indonesia's been going through a lot of issues with this, and part of the problem I would suggest is that the accounting standards may vary to other countries, and it's difficult to clearly identify always what the state of your customer's position is. But I mean, it's important to fully establish who is the customer. In Australia, we estimate around a quarter of our customers have incorrect data of their customers. So when there's a name change, director change, maybe a buyout, or simply they've got the wrong style of company, it needs to be clear that they're assessing the right company. And what we look at then is the different aspects. So it's the age of the company. Are they well established? Have they been trading for a long time? How much share capital have the directors invested in that company? What is the paid up capital? Who are the directors? Have they been involved in other issues, other failed companies? How long have they been with the company? Are they long-standing directors or are they new? If there's many director changes, that would be a cause of concern to us. Why are they changing? What is the situation at the company? What other companies do the directors are involved with? Are they part of bigger groups? Do they have lots of experience? Or have they had problems in the past with other companies? Then that would be an alarm bell. We look at trade dealings with other suppliers to see whether there are trade references that we can get to investigate whether they're creditworthy. We also would like to undertake adverse checks, check whether there is a court action or slow payments, or if the credit companies, there's lots of credit companies in Indonesia that will give you a rating on customers, so it will help you understand the business better. What projects are they involved in? What work in progress are they underdoing? And quite importantly, the financial position. So if we can get audited financial statements, although they are historical and they look backwards, it's still a useful way to establish what the business is doing and understand that. And then finally, do they need a license? Many different industries need that type of thing. And if they're a small company, you need to check to make sure they're able to do what they say they want to do. So I was asked as part of this discussion to talk about the typical risk sharing portion related to bank finance facilities. It does depend. It's not a hard rule by any means, but the lower risk sharing from a bank perspective. So if they can get more from if the insurance company can see the bank as taking more risk, they like that. Obviously, having less exposure and more bank interest in that debt, then the insurance market is more likely to be supporting that. Now, there's a new regulation coming in Indonesia, which is reducing that indemnification or indemnity from 90 to 75%. So that will give the insurers more comfort to write more risk. What way that it's priced outside of Indonesia, normally there would be a 70% ballpark figure for the charge of insurance against the bank margin. And that would then be an idea of understanding how much money the bank is making on the loans, what sort of setup costs and fees and ongoing fees there might be. And then because the insurer is taking the risk where the bank's money is being used. So there's a cost of capital versus risk exposure calculation to be made. Outside of Indonesia, in the sort of the main markets I've worked in, which is the UK, Australia, Hong Kong, and Singapore, financial guarantees or insuring a loan is very difficult. It's not an easy thing to do. And the insurers would normally say, to ensure a financial guarantee or a loan, the risk, the debtor needs to be double B rated or higher, and have equity of US 300 million. So clearly SME, medium enterprise loans wouldn't be insurable. And the reason being is that there is just too difficult to track and to see the trends. And in a loan obviously charges interest, or the insurers don't get that interest. They only have a premium which is charged. So the bank is in a much stronger position and often will take some sort of security over that loan. Credit insurance on loans just isn't a practice outside of Indonesia. It's not a global practice at all. So the next question I was asked about was, what is the typical collateral used to securitize a typical bank loan, working capital, trade finance, project finance in APAC, specifically in Australia? So for banks to issue loans, they normally want security. And that might be a mortgage over a property. It might be the personal guarantees of a director where they physically put their own house and their own assets up against the loan. Australia has this PPSR, which is the securities registrar, which means that the debt is secured against whatever assets are being funded or financed. So, for example, if it was Komatsu diggers and dozers and dump trucks, then the PPSR would be over that equipment. So if a company was unable to pay, then that ownership would come across to the bank, and the bank would be able to sell those assets to recuperate the loan that they provided. So it comes down to having that control and being able to do that. Retention of titles is a looser form of the PPSR in most countries, where the title of the goods are then handed to the bank or the financier, but then they need to be able to action them. So if the company they've lent money against has disappeared or gone, then it's going to be very hard to try and find that equipment, or it's been unsold or disappeared. But having that title gives some level of comfort. Bank guarantees, so maybe they can get other banks to provide guarantees on the loans. And what I'm specialised in, what we do a lot of, is the credit insurance, and that's over the receivables. So if it's a receivables funding or receivables financing type policy, they can use the credit insurance to then secure the bank's position in the event that the debtors that they funded don't pay back the loans. So it does vary, but security over the project, over the end issue is important. But what you can see there is there's no credit insurance company. If there's a loan, then it's the actual asset. So banks normally would only fund if they've got confidence or security up to that level that they're going to get repaid. They can't rely just on an insurance style product. Is credit insurance commonly used in collateral and bank loan facilities? Only in receivables funding or receivables finance. That's credit insurance is common. It can directly be linked then. So the facility is linked to the aged receivables exposures, and then you're getting lent against as a percentage of that. It can also support loan facilities, but not normally as a 100% security. It can be form part of the package where the cash flows through the receivables are secured. And same as before, so the collateralizing bank, we'd use bank guarantees, mortgages, and security over the directors. And I would argue that Indonesia in the past, by using credit insurance to fund loans, is a non-traditional way of using credit insurance and securing loans. So that's my brief, I think. I'm happy to take any questions that you may have. Maybe I went a little bit quick on that, but it's important to understand that when you're looking at securing loans, it's about getting the security you need and you can act on, and it leaves the banks in a position where, one, they're comfortable to provide the loan, and two, that they have enough security that will strengthen their position if needed be.
in the view of credit risk sharing and collateral usage. Just a quick question though, with bank loans, do you think that would be the first option of safeguarding your collateral will be credit insurance or credit risk management, say? Just a quick question. For other viewers, we will have a slide link later on for you to be putting your questions in, and we'll be directing the questions to either both our speakers later. Okay, Stuart.
So bank loans, credit insurance can be used for some bank loans, but not necessarily for all aspects of loans. So it depends what that loan is for. So if it's for the receivables loan and they're leveraging their debts from the money owed to them by their customers, then yes, credit insurance is a very valuable tool to be able to use and gain the support and give the comfort to the bank that the money they're lending is actually secured. Now, if they're giving a working capital facility where they're just giving some funds to do projects, then credit insurance may form part of the securitization that the bank is looking for, but I wouldn't expect it to be everything that the bank could rely on. They would need more than that. So it just depends on what type of loan and facility is being issued. It also depends on how the assets being lent against are secured and how they would look at monitoring that. So, you know, the credit risk that I started off, the credit risk management, is about how you manage and look at a customer or a bank debt or whatever it might be, and monitor that aspect of their ability to repay loans or receivables or whatever it may be. So it's important that both banks and corporates look at how they monitor their exposures to be able to then know whether it's a feasible loan or credit term to be given to that company, and how would you give that company, and then what are you doing to monitor their ability to repay, and whether they have the right licenses and have the right staff and directors that haven't had issues in the past and have a good track record. So it's all linked in the way that credit insurance is a valuable tool in many ways, but yet on the other side, even if you have credit insurance, you should still be trying to avoid a claim. You don't want claims on your credit insurance policy. You want to be trying to manage your exposures, manage how they pay. You want to be effectively collecting your money quickly and asking to be repaid and being on top of your debtors to make sure they get repaid in a timely manner. So it's all encompassing, but it just depends on what's of a loan and what is the security required by the banks to give them comfort that in the event that there isn't a payment, that they are then secured through other means, whether that's ownership of the asset or personal guarantees from the directors or mortgages over the factory or over the directors' own houses, to be able to provide that.
All right. Thank you, Stuart, for the answer. So those of you who have any other questions, there is going to be a Slido link later on. Just be aware. Thank you. So our next speaker is no stranger to the credit risk management in the insurance world. I welcome Mr. Ricky Natapraja. Mr. Ricky Natapraja is a market veteran with more than 25 years of experience working in the Asia-Pacific region. Before entering the insurance industry, post-Indonesian economic crisis in 1999-2000, he was instrumental in leading several financing deals for acquisition financing, be it equipment, machinery and plant, construction, debt restructuring, working capital, and trade finance, AR structured and supply chain, ranging between 1 to 50 million US dollars across a wide spectrum of industries. In an insurance career spanning 2 decades, Ricky has held several senior executive management positions where he has served as Director of Aviation and Construction Risks at PT Willis Indonesia, Vice President Strategic Business Development at PT Howden Insurance Brokers Indonesia, Country Manager at Wilhelmus Indonesia, Director Credit Insurance PT Allianz Utama Indonesia, Deputy Chief Sales Officer in Strategic Sales Management, and Country Head of Trade Credit Insurance for PT Sompo Insurance Indonesia. And lastly now as President Director of PT JB Boda Viva Indonesia Reinsurance Brokers. Now, regarded as a leading expert in trade credit and financial lines in Indonesia, Ricky has appeared as a speaker at some international conferences, such as Indonesia Trade and Commodity Finance Conference, hosted by Global Trade Review, Standard Chartered Bank Corporate Client Event, Second Annual Indonesia Infrastructure Finance Conference hosted by Euromoney, Sharia Economic and Finance Outlook 2022 webinar hosted by Warta Ekonomi, and in 2024, the 12th Asia Insurance Broker Summit in Singapore, hosted by Asia Insurance Review, and also the 23rd Association of Insurer and Reinsurers of Developing Countries, AIRDC, conference in Bangkok. Now, he is also a lecturer for financial lines, credit insurance, and surety for the APARI Insurance Broker Education Programs since 2014, and a guest lecturer on project management and operations management at Indonesia Institute for Management Development, IPMI, for MBA postgraduate studies in 2008 and 2013. Since 2019, Ricky has been the lead trainer for trade credit insurance, bank guarantees, credit risk management, and surety bonds training program for Indonesia Exim Bank. Ricky lived in Sydney, Australia for 25 years, where he obtained dual qualifications in civil engineering and business management, and he currently holds dual fellowship qualifications from ANZIIF and Asian Institute of Insurance, formerly a Malaysian Insurance Institute. So without further ado, floor is yours, Pak Ricky.
Assalamualaikum warahmatullahi wabarakatuh. Salam sejahtera, semangat pagi, Om Swastiastu, Salam Namo Buddhaya, salam kebajikan. Apa kabar Bapak Ibu? Welcome all APARI and ANZIIF friends to this international webinar on best practice credit risk management, reducing the impact on the insurance industry. Thank you to Stuart for his presentation and his insights on what the best practices are and the common practices are in Australia for risk mitigations and using credit insurance and the collateralization process. So I'm going to bring this all into a more local context, and let's see where we can see the similarities of what the best practices are in Australia and what is happening in Indonesia. The moderator this morning, Roy, mentioned that we did see a big bubble burst or credit crunch after COVID, with so many SME or retail personal loans defaulting. Hence, the credit life industry in Indonesia suffered quite a big hit. And as Stuart mentioned, credit insurance for loans is not a common thing in the Australian markets or even elsewhere within the APAC Oceania region. It's more or less an Asian or Indonesian product or structure. Can we have the presentation, please? All right, so we're going to talk about, first of all, let's have a look at the Indonesian credit insurance market, the sovereign and credit risk rating. We'll look at also the credit risk management, the types of bank financing and the typical collateral structures and security for both asset-based financing and trade finance. And we'll touch on a little bit about that, the new regulation on credit insurance with the risk sharing. So a bit of background, Roy mentioned earlier that before I joined the insurance industry, I was involved in a lot of project financing, bank loans, and lead financial arranging for companies ranging from mining through to telecommunications, and loan amounts from $1 million to up to 50 million. And these are some of the success stories that I've had. So I've had the best of both worlds, being a financial arranger and working with banks and lenders, and now in the insurance industry, structuring the collateral, the credit risk side. So let's have a look at the Indonesian credit insurance market and the sovereign risk, because this is important. If you have a look, this is data from the Indonesian General Insurance Association, or RUI. So in 2023, the performance of the market, credit insurance, and this is sort of bundled in. So credit insurance has credit life, it has credit guarantee, trade credit, and all other variants of credit insurance, all sort of reported and bulked into one. But in general terms, you can see that the credit insurance in terms of gross written premium has grown year on year from 2022 to 23. And you can see a big jump of 56% in total premium for credit insurance. It actually became the second highest line of business second to property, and ahead of motor vehicle insurance. So it surpassed motor vehicle insurance in 23. But at the same time, with the increase of premium, the increase of number of policies, the number of claims also increased. If you look at 2022, just at the tail end of 21, you can see that post-COVID, a lot of claims, a lot of loan defaults happened. Claims rose by 65%. Then in 23, it rose again by another 33%. So this just indicates the severity of these small retail personal lines of lending using credit life or other products to mitigate loan default payments of the borrower. Indonesia's credit sovereign rating and risk rating is important because investors, bankers, foreign banks look at Indonesia and they benchmark it, of course, against other countries, their solvability, their investment grade. And we also have, outside the credit rating of the sovereign side, which is done by your Standard & Poor's, your Fitch, your Moody's, Indonesia's been a very good investment grade. Recently, you can see there the dates of 2024, they've updated and most of them have remained their rating at BBB for Indonesia, right, which is investment grade, which is a good sign for Indonesia, and hence a lot of investment has come back into Indonesia the last 3 or 4 years. But what's important to note also is we have insurance companies out there like Allianz Trade, Atradius and Kofas that also do Indonesia country risk rating. And this is the rating that they give a country in terms of the safeness of doing business, payment habits and the fluency of payments from obligors and buyers, and the difficulties of recovering or subrogation. So when back in the days when I was still working for Euler Hermes, for example, it was a very big struggle for us to get credit limits for customers or buyers because Indonesia's current country rating at the time was C. Now it's been upgraded to B, or it's now from across the board, low or moderate low country risk levels. So that's a fantastic improvement for Indonesia. And these were just recently upgraded, as you can see, in September and October of this year. So these country risk ratings are really fresh, hot off the press from the various insurers. So let's look at credit risk management. Stuart this morning introduced the various methods and where to start and how to do and what to look for. So I'm going to look at, discuss a little bit how we implement or how we can apply those risk mitigation strategies. But first of all, let's have a look at why businesses and companies fail and why they end up defaulting on their obligations to the banks or the lenders, right? And of course, impacting to the insurance company. First of all, the financial capabilities. Usually they have limited or restricted financial capabilities or limited cash flow, and all their assets are overstressed, meaning they have very, very little or no liquidity. Even short-term liquidity for 3 to 6 months is not there. Hence, they have trouble paying their obligations or commitments to creditors or suppliers. They have no strategies in place, as I mentioned, to mitigate, prevent, transfer. And those risk mitigation transfers are for customers, what to do or what they need to do if a customer doesn't pay after they bought the goods. How do they collect the money? And that will obviously impact on the cash flows and the liquidity of that company. And again, a domino effect on the liquidity to pay to creditors and suppliers. And another thing is they're not looking where they're going. So they assume that everything is fine. In a world we are living in now, which is always changing, emerging risk, we've got geopolitical risks, we have cyber risks, we have climate risks. All these things are actually impact on the way people do business. And you need to be aware of those things because they can impact. If one country decides to start a war with another country, we've got wars happening now all over most part of the world now. So that will impact on the way people do trade, how money is transferred from country to country, or how buyers are allowed or not allowed to transfer money to other regions of the world. So you need to be proactive in those risk management strategies and to always refer back to your original business plan and where you're going to be going forward. And they don't spot or anticipate changes in the environment. People, behaviors of customers, the way that people buy from traditional going to a shop. Since COVID, everybody's been mostly buying household consumer goods, even food online. So people are no longer going to the markets or to the shops or to the commercial centers. Most are doing whatever they can online. The market dynamics are changing, and also different laws, different regulations are coming into play. So, and they don't monitor well enough what's happening, and they seem to let it go, and then they realize, oh, we have a half a dozen invoices, we're not getting our payments from our customers, we're suffering in cash flow liquidity, so they start putting up the red flags to their banks and their lenders. So what's the purpose of credit risk management or risk management in general? Basically, it's to reduce the total cost of risk. So if you have a look at this pie chart, for example, there are 4 quadrants. You're going to have loss management, right? You're going to have uninsured losses that are just not going to be able to be insured. Okay, there's no insurance company that will take up that risk or portion of that risk. There's going to be functional costs, which also forms part of your operation risk, and possibilities or options for risk transfer. Now, if we go into a bit more detail, we segment that even further. On the functional costs, you have things like supply chain costs and strategies, your finance and treasury costs, and your sales and commercial, your marketing, all the things you need to acquire your business and acquire your companies and clients. And then you need to look at how these risks can be transferred. For example, the credit risk, the terms of payment that the companies give to their buyers or customers, anticipating payment defaults, and maintaining the customer insolvency management to avoid debt, right? To avoid undue payments not realizing after a period of, let's say, 6 months. So the whole idea is to work out these strategies so that you can transfer whatever you can, either through a third-party agreement, or it could be transferred through some sort of alternative risk transfer mechanism, or it could be insurance like credit insurance. So at the end of the day, your cost of risk or the size of the pie that you have to take on board or your client has to take on board becomes relatively smaller. So Bapak Ibu, kalau kita mau bicara nih, reduce total cost of risk, risk management itu tujuannya untuk memperkecil. Jadi kalau tadi ada istilahnya tekor ya Bapak Ibu, ya saya mundur dikit ya. Nah, total cost of risk itu bahasa Indonesia tekor. Nah, Bapak Ibu ngerti kan? Kalau kita tekor, dompet kita tekor, berarti kita berlebihan belanja, tidak manage expenses kita. Nah, sama kita bisa aplikasikan kata-kata tekor di bisnis, korporasi, dan commercial banking, lending, dan insurance. Nah, tujuannya selain memperkecil or the reduction of the cost is actually also to protect your balance sheet. Bapak Ibu, as brokers, as consultants, as advisors, you need to be able to advise your clients the best way and how to manage their balance sheet. Because if you don't realize that invoices or receivables are actually more than 35 or 40% of a company's assets, you will never understand that that's the biggest area where defaults and liquidity issues happen when payments are not received. And accounts receivable are as good as cash. And I'll explain to you later on how that works. And banks actually prefer, the big operating banks like your JV multinational banks, prefer accounts receivables because they know that the supplier or their customer has delivered the goods, they have received confirmation that the goods are received, and the invoice has been issued, meaning it's just a matter of time before the payment is received. So there's no performance risk in making the goods whatsoever. But if you have a look, 40% of a company's balance sheet is accounts receivable, typically. You've got other assets like buildings, machinery, plant, equipment, even the executives and employees. They all can be insured. Now, if we talk about insuring receivables, there is a product which is trade credit or credit insurance which can mitigate the risk of non-payment or default of a customer. Because if you have a look at the receivable side, 40%, which is accounts receivable, from that 40%, more than 60% is actually unsecured, which means there's no security or collateral. So the supplier just sells his goods, trusts the customer they will pay in 20 or 30 or 60 or 90 days, whilst the other side is collateralized with either certificate of land perhaps, or a bank guarantee, or letter of credit, or standby letter of credit, or it could also be cash in advance. So the customer pays in full, then they deliver the goods. So there's no risk. But the issue here is, if it is totally unsecured. So you've got the unsecured portion. Now 100% of that 60% is a big share, and if you get 2 or 3 customers in a year defaulting and not paying, that will severely impact the customer's liquidity or the supplier's liquidity and their ability to honor their payments and obligations to creditors and their suppliers. Now, once a customer has short-term cash flow liquidity issues, this is the start of what will usually happen, and bad debt will eventuate. Now, going back to that credit risk sector and credit risk management, credit insurers, and I'm not talking about the policy wordings or the technical policy wordings, but most of the credit insurers around the world, they have their own, as I mentioned, credit risk rating and sector ratings. And you can get this information off the website, right? So, Bapak Ibu, informasi ini bisa Bapak temukan, dapat dari website masing-masing perusahaan. Now, by using this information, and information is key. Stuart mentioned that you need as much information on your buyers, on your customers, on the borrowers, to be able to understand what probability of risks and default will occur. If you're an exporter, you need to know which country is a high-risk country of bad debt or slow payments. You need to have access to an insurer that can do follow-up negotiations and debt collections as well if your customers don't pay. Look at which sectors you are dealing with. If you want to sell to the Middle East or somewhere Far East, you know there's going to be difficulties, or it's a red zone or a high risk, then you need to rethink your strategy on whether to proceed in dealing with that customer or not. As you can see here, the likes of Allianz, Atradius, and also Coface have similar databases and similar information which brokers and clients and companies can use to better understand, oh, if I send my goods to the US, to Southeast Asia, to Canada, to Europe, will I be safe? Will I get protection from the insurers because they have appetite for that region, or will it not be covered whatsoever? We then use this information to apply it to the techniques of risk management. Now, simply, you have your green, your yellow, and your red, or your traffic light system. Green meaning it's acceptable, yellow meaning it's a medium risk, needs to take caution. Then you've got your orange or red, which means it's unacceptable or highly unacceptable. So the probability of default is, of course, quite high. All of this boils down to, at the end of the day, when you're talking an insurance product to secure the risk of non-payment, it's all about understanding the quality of the credit risk, the quality of the customer, right? The better the quality of the customer, the better the quality of the risk, the better financing terms and the better coverage you'll most likely get from the insurer. And the two areas that you need to look at is the financial risk of the supplier and the customer's ability to pay. All of these, at the end of the day, interconnect with each other to determine the likelihood of the probability of default. And eventually, what the insurers will do is then score this and put it on their premium pricing tool. And of course, if it's a low probability default, then the premiums are likely going to be a little bit better. Compared to a high probability default, the premiums are going to go up the scale. So it works in tandem and in parallel to the quality of the risk, means lower premium, bad quality risk, high premium and probability of default. So the things to consider if you are working with a client that's doing bank financing or is in the process of getting a facility, that you need to advise them on what sales and commercial risks they are facing from their customers, what operational risks they are going to face. It could be anything from disturbances or machinery breakdown of the company, their treasury and their financial standings, the customer payment history, and the country risk. Even if domestic, they're selling in Indonesia, that needs to be considered. Which areas, which regions, which provinces have customers known to pay late, right? Which countries overseas tend to have slow payment habits. These are all things that impact at the end of the day to the financial or the ratings of your insurance policy, which cover you need for your client. So let's have a look now at the types of bank financing and collateral structures used as security for most bank facilities. So I like the Star Wars movies, right, guys, ladies and gentlemen? So I'm going to use this. So instead of a long time ago in a galaxy far, far away, I want to say a long time ago in a country not so far away, Indonesia. So typically, Indonesian banks control and dictate the financial services industry. Insurance companies basically have very little to say in any finance deal structuring, and this is based on my experience. And literally they have to obey and follow whatever the banker requests to the insured, right? So whether you're doing asset-based financing, mortgage lending for home loans or apartment loans, working capital, trade finance, or project structures or project finance structures, the bank has control over the terms and conditions, especially on the collateral and security side and the risk transfer mechanism. So basically, we're talking about 100% risk transfer. So the bank will just offload the whole risk to another party. They don't want any risk on their book. Ya, mungkin Bapak Ibu pernah mengalami dengan bank, dia itu pasti minta full collateral cover, 100 kadang 120% dari nilai pinjaman. Itulah typical banker. So basically, and this cartoon basically depicts what's happening. So insurer has to follow the bankers. What they want, they need, we have to give. And the reason why is, I guess, the regulations previously were not very clear or very, I guess, understandable to a certain degree on how the credit mitigation works. If you go back to 2008, there was a law from the Ministry of Finance regarding the implementation of credit insurance and suretyship, right? And if you have a look here, I mean, I've gone through this regulation and I could not find any word that says subrogation. So that's why the banks feel they are in a higher position in insurers, because the old regulation didn't require subrogation. It was either agreed or not agreed in a bilateral agreement between the bank and the insurer on case-by-case basis or under an umbrella contract structure. So the old regulation, if you can see here, the insurance companies had to cover a minimum of 70% of the risk, minimum 70%. So it could be more. The bank submits a claim to the insurance company no later than 1 month, right? But it should be at the stage where the loan performance is doubtful atau meragukan, according to the BI checking, BI call standards, right? You have call 1, 2, 3, 4, 5. Now, doubtful or meragukan is number 4, call 4. So it's almost nearly 150 days past due date of the obligation of the borrower. And the other thing that put the insurance companies at a very big pressure is once a credit insurance claim is deemed to be valid, the insurance company has to pay within 15 days to the bank. Yet they are holding collateral. I can guarantee you the banks will be holding some sort of fixed asset or cash margin deposit or promissory note or director's guarantee, but they don't call on that asset. They always seem to panic and call the insurers, I want my money. I want to claim against my policy. Now, the other issue that I have found is that in practice, people conflict the term credit guarantee versus insurance, and I'll explain that later on, because a credit guarantee is unconditional and irrevocable, whereas a credit insurance policy is an indemnity basis and conditional upon certain criteria meeting the underwriter's requirements to qualify as a claim. So if you look at a typical bank financing structure, like I said, you've got asset-based financing, mortgage-based, working capital, trade financing. In trade financing, you've got AR, pre-shipment, post-shipment, supply chain, and all the rest of it. So if you look here, for a trade finance facility, the term is maximum usually 180 days. As Stuart mentioned, it's for receivables. So a supplier sells his goods to a customer. He doesn't want to wait 60 days or 90 days. He has a facility with the bank. He can draw down money, and he will ask his buyer to pay to the bank in 60 or 90 days, whatever the terms of the invoice are. So there's documentation, as you can see on the right-hand side, that the bank will need, right? And indemnification is up to 90%. For structured trade finance, which is your medium-term length or tenor, 180 days plus, up to maybe 5 years in some cases, it's for things like buyer's credit or import financing. They are buying goods or equipment from overseas. It will take some time to deliver and install, so it's a longer term. But this is normally on a 70% indemnity, or even in some cases 50%. The bank will ask, the insurer will ask the bank to take a share of the risk. Then the final one is project financing, where this is basically long term. It could be 5 years plus up to 10 or 30 years, like it could be infrastructure, could be installation of the MRT railway, or it could be building of a port. So the revenue doesn't start until the project is finished and it starts operating. So the revenues pay back the loan. So there's some credit risk mitigation and insurance on perhaps the revenue streams, and the insurer will take some sort of subrogation rights over the revenue in the event of a claim. So let's have a look now of what happens when a bank structures a loan. You can see here in this table, there's different types of collateral. You have fixed assets, right? Building and factory. Normally, the bank says this is the primary collateral, jaminan utama. Let's say if a customer wants to borrow $10 million, I'll go to Pak Roy, he's the banker, I want to borrow 10 million, and Pak Roy will say to me, okay, Rick, what's your security? I say I have a building factory. My factory was appraised at $10 million. But the bank is not going to lend 100% of that 10 million. He's going to put what's called a risk-weighted asset. So he's going to put risk weight, meaning that there's going to be some allocation of risk and adjustment in the event that that asset needs to be sold in the event of a default. So it's 70%. So he writes down that asset is worth 70%, $7 million. Then I say to him, I've got cash collateral. I have $500,000 cash in the bank. Now, cash is different. So he will value my cash as 100% because it's fluid, it's liquid, it's available. Whereas a property, you have to auction, you have to sell, so it takes time. So he gives me 500,000 one-to-one. I want 10 million, but I only have 7.5 million in collateral. So that's not enough to secure the loan for 10 million. So maybe there's other collateral, like secondary collateral, lapisan kedua, equipment and machinery. Peralatan mesin-mesin bisa dijaminkan. Let's say I have $1 million worth of machinery, but because machinery has a depreciation value, Pak Roy, as the banker, says, I can only give you 50% against your assets on machinery and equipment. So that's only worth 500,000. I then say, look, I've got inventory stock, raw materials, stock that I need. I pledge that as secondary layer again, and that's 500,000. He gives me 50% risk-weighted average. So that's 250. So when you add that all up, my primary and secondary structure is 8.2 million or $8,250,000. So there's still a gap of $1.225 million if I want full 10 million. So I use the additional support of credit insurance. So I go to the credit insurer and he says, yeah, we can support you with your receivables or whatever, and 1.75 is the maximum indemnity or maximum liability. But the insurance company can only give 70%, not 100% of the invoice or recovery value. So that means whatever invoices I have, 1.75, the bank's only going to get 1.225 in return for any claim payment. So if you add that all up, collateral A, B, and C, I only have $9.475 million in total collateral. That's still not enough, but that's all I have. So it means the bank, Pak Roy as a banker, can say to me, okay, Rick, I'll go on this, $9,475,000 in collateral, so I can give you 80% of that 9.4. So again, I'm only going to get 7.5 million in actual loan funds or facility to run my business, to support my business, right? So as you can see, the bank is over collateralized. The bank is over secured. That's why it's a ratio of nearly 120%. Now, if you look below, the strange thing is, whilst the bank holds buildings as assets, cash collateral as asset, in the event of default, based on the old regulation, that the insurance policy can only be claimed if the loan performance or the credit performance has hit call 4 or collectability 4, yang saya warnai orange. Artinya kelancaran debiturnya sudah diragukan, doubtful. But for some reason, when a borrower defaults or the customer of the bank defaults, within 30 days, the bank will pick up the phone, the insurance company say, hey, I have a customer default, I want to claim against the insurance policy. And the other strange thing is, the insurance company doesn't get any recovery or subrogation against those assets that the bank is holding. That's why we're having such a big impact, big losses for the insurance industry of all these non-performing debts. Now, just a little bit of a note, there's RWA's risk-weighted assets. It's the amount of weight according to risk, and this is the way the banks look at various assets and give them weightage on the liquidity of the asset. And the next point that I'd like to convey to everybody is that in the past, there's been a misunderstanding role and function of credit insurance. Credit insurance versus credit guarantee are two different things, right? Please understand that. So to avoid we have problems again going in the future. Credit insurance is not credit collateral, ya. Polis asuransi kredit bukan kolateral, right? And credit insurance is not a credit guarantee. Karena kata-kata guarantee adalah produk dari bank. A guarantee is a product of a bank, not insurance. So that's why it's a very strange, very weird why di Indonesia ada namanya penjaminan kredit yang diterbitkan oleh asuransi. Because insurance is on indemnification basis. It's conditional. There are conditions of the policy that allows claims to be paid. If you don't fulfill the conditions, if you don't fulfill the requirements, the claim is not approved. Simple as that, right? And credit insurance is a credit enhancement tool, Bapak Ibu. What does credit enhancement mean? Credit enhancement is a strategy for improving the credit risk profile of a business, usually to obtain better terms for repaying debt. In the financial industry or banking, credit enhancement may be used to reduce the risk to investors or certain structured financial products. Okay? You start to see the difference now between what is credit insurance and credit guarantee. Another definition is credit enhancement is the improvement of the credit profile of a structured financial transaction, or the method used to improve the credit profile of such products or transaction. It is a key part of securitizing transaction in structured finance and is important for credit rating agencies when rating a security. Nah, jadi polis asuransi ini tidak bisa dianggap sebagai jaminan. Salahnya dan sayangnya di Indonesia itu polis kredit asuransi dianggap sebagai jaminan. If you talk trade finance, what is the collateral for credit insurance? It's the invoice. That's the asset. What does the credit insurance do? It enhances the risk. It improves the quality of the risk by reducing the probability of default. If the customer doesn't pay, where does the bank get the money from? They get the money from the insurance company that will fill in the gap because the customer didn't pay the supplier back. So credit insurance should only be used as a credit enhancement tool to enhance the quality of the risk and to reduce the probability of default and its financial impact. Now, the underlying collateral, as I mentioned, is the invoice, trade receivables, or even promissory note or director's guarantee that they will pay. Yeah, so hopefully this can provide more clarity to all APARI friends and ANZIIF friends. There's two types of credit insurance. The bank buys the policy to secure non-payment of the obligor, which is the first diagram. Then you have trade credit insurance, which secures or protects non-payment of the buyer to the supplier. The insurer pays to the supplier if the buyer doesn't pay. So that's the two differences. And there are other types of trade financing. You have structured financing, project financing, and all the insurances will fit into the structure of this mechanism of risk management. So this last section now is on about the credit insurance regulation in Indonesia. And I mentioned earlier, I like the movie Star Wars. So now this is my theme, the insurer strikes back, Bapak Ibu, right? So Indonesia's new credit insurance regulation and the impact on the banking and insurance sector. I like to say the pen is mightier than the sword. So everybody knows that OJK released the new regulation, OJK number 20, 2023. The background behind this was necessary to strengthen the regulations and improve the governance of credit and Sharia financing and the insurance of it, and implementing risk sharing between insurance companies and creditors, right? And this is the important thing. And it can be applied to credit insurance products for distribution transactions and credit insurance products for trade transactions as well. The new regulation and the new requirements excludes credit life insurance, so it excludes natural death, loss of employment due to voluntary resignation or criminal act or breach of employment contract. Now there are five, in article number 5, there are 3 areas I highlighted here. So it is there to intend the bank to take up risk sharing, right? And the minimum risk sharing by the bank is 25%. So any deal that's with a bank now that requires credit or trade credit insurance, the bank must take 25% risk sharing. Okay, I'm not going to go through all the words there, but this material will be shared with you through APARI. But this is the essence of this new regulation to off-take and get rid of the 100% loading of the risk from the insurance and risk participation back to the bank. It is very important now with these new regulations that insurers and brokers get as much information from the banks as possible to underwrite the risk. In the past, even my time previously as a credit risk underwriter, we were very challenged to get any information, financials, any projections, any credit notes or memos from the bank. Now the regulation states that the bank must share all pertinent information with the underwriter. So if the bank has financial information on the borrower, on the suppliers, they need to share that with the underwriters. And transparency and visibility is very, very key. I was very strict in my days. I would not underwrite anything if I didn't have the information. Right? And going forward for us, all as brokers and intermediaries, to support the insurance industry to get that information, to have visibility on the risk. So in comparison, if you look at the old regulation back in 2008, and you look at the new regulation in 2023, there are significant improvements and benefits for the insurance industry. Previously, for the bank, no risk sharing by the bank. Now, minimum 25% risk sharing. Previously, the insurance company had to cover minimum 70%. Now, insurance companies can only cover maximum 75%. So there's a cap, which will reduce the impact on insurance companies. The banks were not obligated to share credit information. Berapa sering saya ketika minta informasi dari bank selalu bilang, wah confidential Pak, ini data nasabah nggak boleh kita share. Walaupun ada NDA atau apa. But now, the banks must share all pertinent credit risk information related to the credit facility and the borrower to allow the proper underwriting and risk selection by the insurance company. Previously, there was no clarity on subrogation rights. Now, according to the new POGK, there is a mandatory requirement for subrogation and must be clear on the procedures with the agreement between the bank and the insurer. Just a bit of experience sharing with you, it's even better, in my experience, if within the agreement between the bank and the insurer, you add a clause, what's called pari passu, the right to collateral and recovery on pari passu basis. What does pari passu mean? It is a Latin word meaning equal footing, kedudukan yang sama, that describes situations where two or more assets, securities, creditors, or obligations are equally managed without preference. Tidak ada pilih kasih, jadi kalau ada klaim, asuransi bayar ke bank, bank memiliki aset, ada yang bisa dicairkan untuk recovery, itu menjadi hak milik asuransi segera, tidak dibedakan. Itu gunanya dengan klausula pari passu. Untuk bank dulu, credit insurance adalah sebuah instrumen unconditional and irrevocable, dan payment harus dibayar 15 hari setelah dokumen lengkap. Once document is completed, 15 days, they have to pay the claim. Now, the claim settlement period to be agreed to bank and insurer in a cooperation agreement and as per the policy. So these are the improvements now that we can see, and this is the positive impact, hopefully, if all insurance practitioners apply the new regulation and the new strategies for risk improvement. So I've come to the end of my presentation. So as you can see, those transactions that have achieved credit grades are ones with sound rationale, good underlying economics, market segmentation, legal framework and operating standards, conservative cash flow and also sales forecast, a supportive government and regulatory environment, and appropriate financial structure. With respect to the main types of risk faced by financiers in developing countries, we looked at the associated risks and the best ways to manage or mitigate them. The discussion was conducted from the perspective of the promoters or their concerns reflecting other financiers and lenders. And from the analysis of risk, it can be concluded that insurance remains as a supplementary option and not as main collateral. And an alternative solution would be risk sharing for each party involved to bear the risk that it can best manage. So with that, I thank you for your attention, and hopefully I've been able to give you some insight on the best practice credit risk management, and I hand over back to the moderator. May the force be with you.
Yes, thank you, Pariki. That was a very in-depth presentation about credit risk management, role of credit risk and its function, some financial structures we heard. Our next session is going to be the question and answer session. We are going to put in a Slido link. Sudah? Sudah, okay. Now, whilst you are filling the questions, we are going to prepare our speakers, and we're going to take a quick 5-minute break. We're going to set up, and then we'll discuss all the questions with you. All right. Thank you. Next one. and answer sessions. We have been receiving questions via Slido, but before we go to that, probably, Pak Ricky, I'll ask you probably the similar question with what I asked Stuart earlier.
Yeah.
What do you think of credit insurance as a mitigation as opposed to credit risk management? What's the overall priorities in regards to that?
Yeah, thanks. Yeah, definitely credit risk management should be the first step before you talk about credit insurance. So any bank or any potential borrower company or the broker should be looking at the credit risk management strategies first. For example, if they have certain buyers that pay on a certain time frame, what's the probability of that? You need to act as if you don't have insurance. Yes, kita harus bertindak seakan-akan tidak punya asuransi. That's risk management. So if you didn't have insurance, what you need to do? Karena nggak semua asuransi juga bisa cover semua buyer atau semua resiko yang ada porsinya. Jadi ada bagian juga you need to make sure that the company or the potential borrower or the person applying for the loan has the ability to do some recovery before the insurance policy kicks in. That's why in credit insurance policies, typically for the trade side, you have a waiting period, because that waiting period before claims is paid is so that the company continues to chase the payment, chase the outstanding invoices. Or in the case of the bank also needs to follow up on the obligors. Or if they have collateral, like I said earlier in my presentation, credit insurance is not a primary collateral, and it should not be seen as a collateral. The collateral is the invoice. Credit insurance is an enhancement tool to improve the quality of the risk so that, one, the bank's cost of money can come down in some degree. Two, in terms of interest or cost of funds for the borrower, it comes down to a certain degree as well, because the quality of a payment not being honored by the buyer reduces because you've got a well-rated insurance company that's going to step in on the default. So yeah, I mean, credit risk management first, policy later.
Okay, thank you, Ricky. So it's a treatment process, yeah, a treatment priority then. Okay, all right. Right now we are going to have a look at some Slido questions. Okay, here is one from Christian Marpaung. Please share what methodologies and tools to utilize and assess credit, and how to determine the appropriate level of risk for different types of borrowers. He didn't say this is to whom, so probably, Stuart, would you mind answering this one?
Yeah, not at all. So it depends on many factors, and whether you as a company have the resource or the ability to have a credit risk manager, or somebody that has the skill set to assess and analyze the debtor risk. There's many tools out there, and you can use information services. You can use reports that are provided by third parties. One or two of the global credit insurers also provide information services which can be utilized to your benefit. As for analyzing, you need to benchmark and establish with their competitors where they sit. I mentioned earlier about the tools about checking with their trade references. Do they pay other people on time? And are they able to carry on with that trend? So I think it's about having the skill set in your business to be able to undertake the credit assessment, and then having a clear credit practices or procedures in place, which would clearly determine how you're going to assess each buyer. And in our business, we talk about having credit matrices where a very small exposure you might not give any credit to because they're too small to bother. And then as it gets bigger, it's different levels of information that you'd be assessing, and then maybe even asking for other security like director guarantees if it's big or too big for the size of the business. So it really does determine what the company's own risk assessment is and their own risk profile. Some customers would normally give 1 or 2 months worth of cash sales first before they move on to credit, and that process is clearly defined within. But then sometimes someone might knock on the door and ask for $100,000 straight away or more, and it's like, well, how do we get comfortable in offering this? So it's about getting that information. And I mean, Ricky, you can probably explain more about the mercantile information services within Indonesia and the reports you can get, but certainly globally, it's a service that our company would offer, and we use a third party to get access to Indonesian information and asking for financial statements, asking for the projects they're involved in, and doing a direct approach to ask those questions, other than just listening to your sales team who are desperate to do the sales.
All right, thank you, Stuart. It's a very interesting question. Yeah, jadi, hopefully, Pak Christian Mapaung, that answers your question. Just as an information, if you would like to point your questions to one of our speakers, you could put it in the questions, like say, Pak Ricky, this question is for you, or Stuart, this question is for you. Then I'll just convey them accordingly. And now for the next question. This is, I think, definitely on Pak Ricky's side. Dengan penerapan POJK 2023, apakah akan ada perubahan dalam cara penerapan premium rate?
Ya, thank you. Ini kepada anonymous, nggak ada namanya ya?
No, anonymous.
It's okay, but allow me to answer in bahasa Indonesia. So tentunya dengan ada peraturan untuk resharing ini, artinya kan porsi resiko pada asuransi berkurang 25%. Tentunya semakin kecil resiko yang dibebani ke penanggung, premi juga harusnya lebih baik. Ya, tapi semuanya ada faktor-faktor lain yang jadi pertimbangan untuk penilaian resiko. Tapi semestinya, nah ini kembali lagi pada si credit insurance-nya sendiri masing-masing, bagaimana dia akan menilai risikonya. Nah ini berarti salah satu inovasi ya dari OJK dan mengharuskan bank untuk take up share sebesar 25% itu minimum. Itu nggak bisa ditawar lagi. Jadi kalau misalkan ada fasilitas 10 miliar atau 100 miliar, mau di cover sama asuransi kredit atau asuransi kredit perdagangan, 25% menjadi beban dan risk sharing-nya si bank. Bank itu nanti mau pakai metode lain untuk ke cover 25% itu urusan mereka. Tapi dari kita sebagai praktisi asuransi, itu menjadi suatu cara untuk mereview risk kembali. Tentunya penilaian risk rating atau pricing tool-nya si asuransi akan ada different approach karena kuehnya lebih besar, ada sebagian besar di-take sama bank.
Oke, thank you Pak Riki. Baik, kita akan lanjut. For the next question is again from an anonymous. What is your opinion on the proliferation of legal online lending platforms and its impact on credit insurance in Indonesia? I'm guessing this is for you again, Ricky, because Stuart is not in Indonesia.
Sure.
All right.
No worries. Okay, for this one, legal online lending or this pinjaman online, right? I think that's what they're referring to. From my experience, since online lending or P2P lending came out, even before COVID, 2019, we started hearing a lot of pinjol platforms coming online. Most of the big global credit insurance will not touch this sort of financing. One, because the owner of the funds are not clear. Secondly, who has rights over the receivables once pledged? Because behind these platforms or fintechs or P2P lending systems, there are other banks, corporates that put their money in, and there's also individuals. So if you say there's a 1 billion rupiah invoice being pledged for financing, the system disburses the loan, but we will never know who's going to hold that 1 billion. It could fall under the bank's custodian, it could fall under the private investor's custodian, we will never know. And that's why it's hard to say, well, who do we pay the recovery to? And that's why, especially on a high volume game, where you have transactions, maybe 200, 300, sometimes thousands a day, on the small retail side, it's very hard to control. So the big losses will come if insurance companies play in this space, and I would never, as an underwriter, enter this space.
So it means it's very small amounts, but very big volumes.
Yes, yes.
Okay.
Stuart, your thoughts?
Yeah, no, we've placed a few of these type transactions outside of Indonesia, and the way that we structure this is we let the platform itself be the insured as opposed to all these individual or retail or corporate investors, and they basically have a trust set up where they manage those funds on behalf of those investors. But you're right. I think it's difficult when it comes down to the quality of those buyers. Pre-COVID, we had one that was involved in commodities, and the commodities market fell apart during COVID. So that was huge claims to the insurance companies. And then we've got another one which is more successful, but the buyers are all in, I think it's an Indian funder, but the buyers are all US and Europe. So the insurer is comfortable with the credit risk as opposed to worried about the funding platform so much. But if it's domestic in Indonesia, yes, that would be a tricky situation to try and get quick and fast decisions on many credit limits.
Again, it comes back to the different treatment between the Indonesian economy and probably outside economies as well. Yes, do it? Okay.
I think so.
All right,
and,
then.
Yeah.
All right, then we're going to be moving on to the next question. Next question, please.
This is actually one from me, I think.
Yeah. What is your opinion on the? No, hang on. Which
That
one
was
is it?
yeah. The
That's the green one.
question.
Okay.
Yeah.
All right. Why is credit insurance for receivables treated the same as bank loan credit insurance in Indonesia? Does regulator not see as different? For Stuart, not from Stuart. Is it from Stuart to Stuart?
No, that's from me to my partner on the panel. I just wanted to understand more about, the new regulation seems to be blanket across all credit insurance, but obviously the banking loans are financial guarantees. They're not related to trade on the loan facilities. So why is it the regulator treats them all the same?
Yeah, I mean, my understanding of this, Stuart, is that they wanted to standardize basically anything that was credit risk based. So whether it's a loan and that loan is insured for non-payment, a portion that is not collateralized in fixed assets or cash margin deposits, whatever the instrument may be. So that portion is then insured in case of non-payment. But unfortunately, when it comes to the credit insurance policy, in most practices, let's say the gap was $500,000. The bank actually wants the full amount of the facility covered. So it could be $1 million facility, the shortfall is 500. So the bank will ask for a policy for $1 million instead of 500,000. And unfortunately, that's where I mentioned earlier in my presentation, there is that misunderstanding on the fact that a credit insurance policy is not a guarantee. But in the days of old, before I was even born, I presume, they had this idea of saying, oh, credit insurance policy is a guarantee. It is not a guarantee. And that's why I think they've applied the same mechanism for loans as well as trade credit. Now, trade credit makes more sense because you've got a receivable underlying transaction, an instrument, an asset, which is that invoice. And this is where I think needs to have more clarity. And the definition of creditor is also quite wide. The definition of the word creditor could be a bank, could be a finance company, or it could be the supplier giving credit to his buyers. You become a creditor. So the challenge is now whether insurance companies or credit insurance companies will only write 75% indemnity or 90%. Now, this goes back to the credit insurer's internal policy, whether they want to write 90% indemnity or 75%. But in common practices, now that this law is in, it's more specifically related to the bank-related financing. So that's where the 75% comes in, because a lot of the losses and the impact has been because of bank defaults or NPLs.
The global credit insurers they're all moving to 75% as well.
Also, they're moving to that 75% in your markets.
Yeah, they are for Indonesia because they're saying that the law is when it states that credit insurance goes to 75. So there's been a lot of requests to the regulator to try and change it, but as yet, the legal advice everyone's received is that it's 75%.
Yeah.
So let me just continue with the question of, is there a synchronizing terms for the treatment of this credit risk globally? I mean, because in Indonesia, there's one side, and you have in your market one side. Is there a synchronizing terms globally?
Well, I think from a financial guarantee perspective, the credit insurers have reinsurance arrangements, which is obviously to offset their risks. And under those reinsurance arrangements, loans, investments, financial guarantees are excluded. And so therefore they're prohibited from writing such risks. And I think, correct me if I'm wrong, but I think these losses in the bank sector are by local credit insurers, not by the global credit insurers. because they wouldn't be allowed or able to write that type of exposure. Now, it is possible, but as I mentioned, you need a triple B rated entity, never mind country, with at least 300 million US in equity before the insurers will start looking at it. And there's a very limited number of credit insurers that would actually support financial loans, financial guarantees, and investments.
All right, thank you then. Okay, moving on to the next question.
I think that's
Habis
it.
ya? Oh, okay, I see. It is still on the last question. So viewers, APARI and ANZIIF members, if you would like to post in some questions, just if possible, put in your name and who would you direct the questions to, and that would be very great. Belum ada yang baru ya? Belum ada.
Yeah, I think just to add what Stuart mentioned also, there is no global insurer or reinsurer in the credit market space or the credit insurance space that will write SME retail personal loan business in Indonesia. All of it is backed up by the local domestic reinsurers. The capacity is very limited. I think now we've heard of the last couple of years, the local reinsurers using things like stop loss methods. Once it hits a certain percentage of losses, then they only start writing, putting in aggregate first loss or loss limits at certain high rates. So it's almost a cover without cover, if that makes sense, because you can only get coverage when it's hit a certain limit. So again, the banks hit a lot of NPLs, then suddenly dumps all the losses to the insurer. And that's why we've had so much bad situations with credit insurance in the credit life space and the credit guarantee space, because of that, the misunderstanding and the structuring of credit insurance.
One interesting follow-through question though, if there are no global reinsurers who would want to write like SME loans and stuff in Indonesia, then why would there still be local companies who would do it? What are your take on this?
My view, most of it is integrated between supporting the economy from that sense. Some also are part of a big conglomeracy. Some are part of state-owned holdings, so they have to write the risk. But again, it's how to structure that coverage so that, you need to put a cap. You can't write everything for everybody. Even making sure your underwriting is prudent. If you're writing credit life and your borrower is more than, the age limit, let's say 45 or 50, then it warrants a medical checkup, right? And then I've seen situations where the loan has been dispersed, it's due for this first installment, and the borrower dies. He died of a heart attack, or he died of some illness. And when we looked at the documentation, it was pending a medical checkup. So the loan was dispersed, the policy was issued because of what they call an automatic cover agreement in place, an MOU put in place with the bank and the insurer. And automatically covering something is like giving the pen to somebody not authorized or not qualified to accept the risk. And again, as Stuart mentioned, it's not about making that sale. It's not about closing the deal. You need to step back and say, well, hang on a minute, he's going to borrow $200,000 or 2 billion rupiah. He's 55. Why is he using this money for? How is his health condition? Things like that. And instead of just, let's book the deal, let's disburse, and then suddenly, in less than a year, the loan defaults because the guy's passed away.
Yeah.
Okay, so that's and that's the reason why you don't have these sort of loan guarantee schemes in other places around the world. Australia doesn't have it.
Yep.
Yeah, and Stuart mentioned that earlier.
Yep. All right, thank you, Ricky. And we're going back to Slido. There's one question pending. Now here's a question from, again, anonymous. I think this is for Ricky, but Stuart can answer. I'll translate for you. How is the implementation for insurance company to ask for subrogation to banks, and what are the brokers' role on this? What is the implementation for insurance to ask for subrogation towards the banks, and the broker's role in this. Okay, Ricky, you can answer first.
Yeah, thanks. Yeah, definitely. The bank needs to understand that if there's a credit insurance policy in place, especially now with the new regulation, POJK number 2023, there is a condition of subrogation. It has to be there. So the broker's role as the intermediate consultant, especially if you are appointed by the bank as their broker, you need to be able to make sure that before the loan agreement or the facility agreement is in place, there is a condition for subrogation. Now, I mentioned earlier in my presentation at the end that it's even stronger if there is a right to recovery on a pari passu basis, meaning that all collaterals held by the bank, the insurer has the right same footing, kedudukan sama. Jadi ketika asuransi bayar, the insurance pays the claim, the insurance company has the right to recover whatever they can from the bank. Now, especially if they've got a cash margin deposit or cash funds secured or assets that they can give to the insurer to hold, and both of them can sell or liquidate down the track to recover. What's happened in the past, the banks have been very protective because there is no regulation or requirement for the bank to give that collateral or recovery to the insurer. But now, yeah, the broker has a very, very important role now to understand the credit risk and to make sure that before you go to the insurance company and the bank gives you the indicative term sheet or the offering letter for financing, read the conditions of collateral, right? Read the conditions of security, right of recovery, what's the bank's position, what's the insurance position. And even on the policy itself, right? Especially if the bank is buying the policies, so the bank is the insured, in nearly all credit insurance policies I've seen, there's a right of recovery, subrogation. So at the event a claim is paid, the security collateral becomes the property of the insurer. But sometimes the bank will also, in most cases, say, no, it's still mine, it's mine. That's why I put that pari passu clause in, so everybody's on the same level.
Okay, all right.
Yeah, I agree with exactly what you said there. I would just question why the banks, who are in a much stronger position than the insurance company because they can get the security, they can request what they want to as a secured creditor and sit above all the other companies that are out there as debtors, and why they wouldn't want some security as opposed to, I think the credit insurance makes it too easy for the banks to lend and then quickly request their monies, where I think the reality of everywhere else in the world, a bank would only lend when they're 100% secured and can't just rely on a piece of paper, which is fantastic for the bank's position. But the banks they're the big ones, they're the big boys, they're the ones that are going to take the hits when an unforced insolvency happens from someone. So normally they're still secured, they still sit above all other creditors and rank first. But now having a credit insurance policy as well, where the insurer has little or no ability to sit. This new regulation sounds great because one, there's a better risk share, and two, they're going to rank equally to the bank to be able to get some monies back if they're paying out. But still, if I was an insurer, I wouldn't be offering any paper to a bank because the banks are in a much stronger position than they are as an insurance company.
Yeah. Just to also add an observation in bahasa, Bapak Ibu harus diketahui ya, ketika kita structuring suatu jaminan atau collateral package buat bank, credit insurance is a supplementary collateral, quote unquote. The word collateral is wrong. It's down the order. It's the lowest one. The first one is primary and secondary layers. The primary layer is your fixed assets, cash deposit. So in the event of default, that's what the bank should be chasing first. If they've got cash deposit, they should be drawdown liquidating the depositor, the deposit funds, to recover their payment. Then they'll be doing the property, because the credit insurance policy lines up with the SLIC or BI collateral, BI call.
Yeah.
1, 2, 3, 4, 5. Most trade credit insurance policies or credit insurance policies will only respond after 120 days or 150 days. So that means 3 or 4 months. Under BI status, that's already called 3 or 4. So if the bank is chasing, ringing, ignore them. Mm-hmm. Because by virtue of the condition of the policy, they are not allowed to claim or pay the claim until it's past the waiting period. Okay. So this is, again, I'm going to say, it's going to impact the bankers severely, but it's going to improve the insurance company's liquidity, because they can say, no, I'm not going to pay the claim until 120 days or 150 days. The status is meragukan, doubtful. Yep. Before that, Let them recover their own rights.
Right.
Let them liquefy the deposits. Let them cash down on whatever securities they have, because that's the way it is. Because suddenly you have property here, then you have credit insurance policy, and then in an emergency situation, the bank decides, oh, I'm going to put credit insurance on top now because I can cash down. It's easy target. Okay. So, Bapak Ibu sebagai broker, kasih tahu banker, nggak bisa.
Yeah. It's an important broker's role then.
Yes.
From the question, we need to remind or re-educate the way that risk management is done and put probably credit insurance as a support, not as the main form of cover.
That's it.
Okay, we are on to the next question then. Ada? Still waiting, guys. Some sort of typing didn't put in. All right, it seems we're out of question then. The question list seems blank, but I got a report saying there was one. Okay. All right, the question is this. It's from an anonymous as well. Is the subrogation... Hang on. Okay, I'll spell in Indonesia first. Apakah hak subrogasi tersebut berlaku langsung atau harus berlandaskan perubahan tertulis dalam perjanjian? So is the subrogation rights of the insurance company is in effect immediately, or if it needs to be put in writing? I think Pak Ricky would answer this. I think it's in POJK already.
Yeah. In my view, menurut pandang saya, tapi please bicara kepada legal advisor ya, lawyer yang lebih mantap lagi ya. Tapi my understanding is, karena POJK ini sudah berlaku, kan sudah ditetapkan, udah POJK. Berarti kalaupun ada, if there's any agreements between banks and insurers now that have not aligned with this new regulation, amendments to any agreements or partnership cooperation agreements between bank and insurers need to be done. Because going forward, the policy wordings need to reflect subrogation rights. If it doesn't, I can only assume here, and I guess I'm right to a certain degree, if there is any dispute in the coming days, ada dispute di kemudian hari, dan hak subrogasi tidak tertuang dalam polis atau dalam perjanjiannya, pada dasarnya ya itu satu kelemahan lagi buat asuransi. Nah, kalau memperkuat posisi asuransi ya segera revisikan perjanjian addendumkan bahwa ada lagi hak subrogasi sesuai POJK. Very simple sih, tinggal bikin addendum, amendment to the agreement bahwa pasal ini dirubah mengacu kepada POJK di mana hak subrogasi asuransi berlaku.
So any old existing cooperation agreement will need to be adjusted to the new regulation.
Absolutely.
Okay, all right. Okay, I think that concludes our last question. Right now we're at the end of our webinar today. I just have an information to give out. If APARI members or ANZIIF members need extra points for your certifications, we are having a hybrid seminar next week, 21st of November. Hybrid means there's online and offline. Offline being held at Function Hall, Soho Building in Pancoran, with the topic of charter's liability coverage, risk management and claims. It's 21st November, 8 to 12 Jakarta time. Okay, please register at the website SIAP or your app SIAP. Okay, and now, before we conclude our webinar, we would like to thank Stuart for your time, for your effort, and I think we have an e-certificate to give. Ada? E-sertifikat buat Stuart? Oke, bisa ditampilkan sekarang atau kita kirim aja. Just hang on, Stuart. We're sending you something.
Okay, no worries. Well, I'll receive that. So thank you very much. It's been good to talk. And if anyone has any questions for outside of Indonesia, I'm more than happy to help. So
No, if you were here, it will be a physical
Right.
one.
Well, he's just as good. Sounds like me here as anyway. I'm not AI. I'm real. Look.
Yeah, it's good to share the stage with you again, Stuart. Last we
Likewise.
were together in April in Singapore during the Broker Summit.
Yeah, likewise. Been very good. Thanks for the being able to put some input.
Probably any closing statements from you both?
Well, I can go on about credit risk management and the art for months. It's not easy, and there's always the uncertainty of a customer going insolvent or defaulting on payments. And if we all had a crystal ball, we'd all be able to see into it and see what the future is, but we don't. So you just have to do your best practices. And then, I have a handful of global clients in Indonesia, and they would all much prefer to have 90% indemnification rather than 75%. And that causes some consternation about what that means to the value of having credit insurance when you can only get 75% cover. So, and then we hope that the premiums would have to drop because of that, which will be difficult to a growing credit insurance market for receivables, not for loans. I'm just going to stay away from loans. So, I mean, we saw it in India where it dropped as well in the past, but the government then came back and made it pretty much a global standard of 90% cover and can price that on that basis. So hopefully there will be some changes at some point. I know that the global credit insurers are knocking on the regulator's door to say we shouldn't be put all together. It's a different type of insurance product. It's trade related, not lending related. So hopefully that will be a positive. That will then support the credit insurance market domestically in Indonesia moving forwards without the uncertainties that a low indemnification brings. But yeah, happy to talk about credit risk management and the arts, but also I hope Indonesia comes back at least with the trade into the global standardization.
All right, thank you. How about you, Ricky? Any closing
Yeah,
statements?
look, hopefully that the Indonesian credit insurance market space improves, more capacity can come in, more prudency in terms of reviewing credit risk proposals to be covered, any bank structures to follow the proper steps, and hopefully this can serve as a guide for all our broker friends and members of ANZIIF and APARI, especially for Indonesian transactions, so that we can start to help improve and reduce the impact of losses for Indonesian insurance industry, and we can be more healthy and stronger and stable in the years to come.
Okay, all right. Okay, thank you, Ricky. Thank you, Stuart, for your time. And here is the certificate for you. We'll send it to you. Do you need us to? There you go. Thank you for your time, Stuart. All right, then. That concludes our event.
Thank you.
Thank you all for your time, APARI and ANZIIF members. We'll see you in the next international webinar, a joint webinar between ANZIIF and APARI again. Thank you. See ya. Tahun APARI. Nah, harapannya APARI selalu dapat menjaga amanah untuk menjalankan visi dan misi yang dijalankan kepada kami.
Pada saat ini jumlah kendaraan listrik dan infrastruktur pendukungnya seperti stasiun pengisian kendaraan listrik umum atau SPKLU terus meningkat.
Kendaraan listrik itu harus dimulai oleh kementerian dan lembaga. Itu harus bisa memberikan contoh kepada masyarakat.
Saat ini itu memang era mobil listrik sesuai dengan tren otomotif global.
Pengguna EV itu khawatir terkait dengan ketidaktersediaan charging station di beberapa tempat.
Untuk masalah transportasi itu merupakan masalah yang besar.
Tentunya kalau kita bicara elektrifikasi kan harus combine stakeholders ya.
Pertama, penggunaan kendaraan listrik ini baru dilakukan belum heavy gitu ya penggunaannya.
Ke Jakarta Theater di pagi hari. Cakep. Berangkatnya naik LRT, turunnya di stasiun. Selamat datang Sobat APARI di acara wisuda dan tasyakuran APARI 30 tahun.
Luar biasa, boleh bantu tepuk tangannya.
Bahwa wisudawan APARI saat ini semakin memiliki value. Artinya setelah Anda lulus dari pendidikan APARI, maka kualifikasi keahlian Anda diharapkan memang telah meningkat.
Dan tugas BSAKP yaitu bertugas untuk merumuskan, memelihara, dan membina pelaksanaan profesionalitas anggota.
Selamat ulang tahun APARI yang ke-30. Semoga semakin jaya dan terus berkontribusi dalam memajukan industri pialang asuransi dan reasuransi dengan mencetak ahli-ahli pialang asuransi yang mumpuni.